Knowing where buy-side and sell-side liquidity is located is fundamental in being able to identify high probability trades. In this ICT training video, I'm going to show you exactly where to find pools of resting liquidity. Liquidity is where traders place their stop losses. The accumulation of stop losses creates pools of resting liquidity, which are excellent places to look for entries and exits. Buy-side liquidity is located above relevant highs, where the short traders get stopped out. Sell-side liquidity is located below relevant lows, where long traders get stopped out. There are two main areas where you will find liquidity. Number one, swing highs and swing lows. And number two, higher time frame candle highs and candle lows. By understanding where these positions are located on your chart and marking them out, you will always have a very good understanding of where to find high probability trades. Let us start with number one, identifying the swing highs and the swing low points on your chart. When identifying swing highs and swing lows, we can use a 3-candle combination. You can see over here we've got a higher low, a lower low, and then a higher low. So it's creating this 3-stack candle combination, which creates the lowest low, and the candle to the left of it is a higher low, and the candle to the right of it is a higher low. So it's creating the lowest low points. This is how we identify our swing lows, and this is where we can mark out the liquidity being a high potential area. So when price comes down to this lowest low point or the swing low, this is precisely where you want to get ready and look to see how price is going to respond at these levels. And then for our swing highs, we want to wait for this 3-candle combination, get the highest high, and then the left candle is a lower high, and the right candle is a lower high. This forms these 3-candle swing point, which lets you know this is a high probability area for liquidity. You can mark out this area, set an alert, and this becomes a place you really want to pay close attention to when price comes to these levels. Identifying extreme highs and extreme lows in the market are going to be the most relevant areas to mark out on your chart. This is where you will find floods of liquidity resting. So if we look here, we've got our swing lows and we've got our swing highs. And you can see this is where we're going to get all our buy side liquidity on the swing highs and the sell side liquidity on the swing lows. This is where the buyers will be putting their stop losses, and this is where the sellers will be placing their stop losses. So you're guaranteed to get tons of liquidity resting in these regions, and this makes for an excellent strategy. By anticipating when price comes to these regions, there's going to be a reaction when all these resting orders are triggered. So identifying the extreme highs on the chart, the extreme lows on the chart to identify liquidity. Here's some examples. If you can look at the chart, we've got the highest high area, highest high. So these are relevant swing high points in the market, and we mark them out. And you can see if price comes to this area, we're usually going to get a good reaction to how price responds at these levels. You can see price comes up, it taps into the swing high point, this liquidity area, and you get a reaction off that point. You can see orders are being triggered. At our swing low points, you can see this was a relevant low, but when price got there, it did not react to it, so it actually failed in that region, but then it created another lowest low point over here, and now we can wait for price to come to this level, and we can look for a high probability long position when price comes to this liquidity area. Here's another example. You can see we mark out the highest point, the swing high over here. Price comes, it broke through that area, so it failed, and then we get another high created in the market. We mark it out, price comes to that area, and we see the reaction. Oftentimes you'll see these big wicks being created, which is showing you these reactions are being triggered. This is a very strong sign that it is reacting to this liquidity area, and then we can wait for confirmations before we get into our entries. And you can see down here we've marked out the swing low point. Price comes to this area, we can see how it's reacting to this area, and then you can see price breaks back into the range and it takes off. Here is another example. Look at this example. You can see every time price came to a swing high, it reacted. Swing low, it reacted. Except there was one time where it did not respond, and you can look for confirmations first. You can wait for confirmations first. You can see price just broke through this level. There would have been no confirmation to look for a trade. Then we get another swing low formed, price comes, taps into that area and it reacts off it. Another low, taps into it and reacts off it. Now price has arrived at this swing high point here, and we can anticipate a reaction at this area. Liquidity areas are just areas to pay close attention to when price comes to them. Once price arrives, then we want to apply our entry strategies. We want to look for more confirmations first. We cannot just simply enter when price comes to a swing high or swing low points. And if you watch my videos, I go into details about how to look for entries at these places. The secret to this process is your stop loss is their entry. This is the smart money strategy. The smart money uses your stop losses for their entries. Now, the number 2 best place to look for and find liquidity is higher time frame candle highs and lows. And typically I like to use 4-hour candles, daily candles, and weekly candles, but you can use whatever higher time frame candles you like to use. Every candle contains the open, the low, the high, and the close. We want to mark out the low and the high of our higher time frame candles, whether it's the 4-hour, the daily, or the weekly candle. We mark out the lows, we mark out the highs, and these are potential areas where you will find resting liquidity. So this is how it will work. You mark out the high and the low of your higher time frame candle. When price comes to the high, we observe how is it reacting at that point, because we can anticipate and we can know there's resting liquidity in that region. So price comes to the high, and then we're going to look for price to react off of it and come back into the range. Looking for our long position, we wait for price to come to the low of the range or the low of the higher time frame candle, and we observe how does it react at that point. Once it comes back into the range, we can look for potential long entry. We typically use our previous day candles, so it can be the previous 4-hour candle, the previous daily candle, the previous weekly candle, and you can see in this example, this is a previous day high, previous day low. We mark out the high, we mark out the low, and we wait for price to come to the high point. And this is an area where we can get ready and anticipate to look for an entry, but it all depends on how price is going to react at these levels. It won't always react at that point. Sometimes it can break through and create a continuation, or it can react at that level and create a reversal. If you want to learn more about continuations and reversals, please check out this video in the top right hand corner. So what you want to do is you get your chart out, get onto a higher time frame. I've got my daily chart open here, and you can mark out the highs and the lows of the candles, and then you can go onto a lower time frame, and these become areas of high probability where we can wait for price to come to, and we're going to look for entries at these points. What you'll see price will do as it comes to a low point, it's either going to break through the low and create continuation to the downside, or there's going to be a failure to displace where we get this rejection at the low and we get the reversal. So it's very easy to identify what's going to happen at these points, and based on what happens next, if this, then that strategy. Trading is all about being reactive to what is happening. We can never predict what is going to happen, but we can make high probability decisions off of how we can perceive how price is reacting at those levels. In this example over here, I've marked out the previous week high and the previous week low, and as you can see, price gets to the previous week low, it sweeps out the low, it manipulates the low, comes back into the range, and then it shoots off to previous week high. It sweeps out the high, and then it shoots off back down to the low. So these become very high probability levels. When price comes to these levels, you want to get ready and you want to observe how is it going to react. So here we are on the charts, and I want to show you an example of identifying these swing highs and swing low points. So what you want to do is you want to look for the highest high you can find, and then the lowest low you can find. So remember, it's the extreme highs and the extreme lows. And then we want to wait for price to come to either the high or the low and observe how does it react off of that area. You can see price comes to the low and we get a reaction off of that area. Let us see. And there you go, it gets to the high and we get a reaction off of that area. So now we can mark out the new high is created and a new low point is created, and we can keep playing to see how price is going to react. So you can see at this point, price has broken through this low point. Price just broke through, showing continuation through these lows. So now this is our new low that's being created, and this is our high point that's resting over here. So there you can go. You can see price taps into that low point over there, and it just moves on upwards. comes back down, and we can mark out these new lows, and you can see price comes back in, taps into these lows, and then we get a reaction off that point once again. So now the swing high becomes our draw on liquidity, and we want to observe what is going to happen next. Price comes all the way up, taps into that liquidity area, and we get a reaction off that point. But right now I'm in real time, so I can't go any further, but you can see price as it's reached this highest swing point, which is a sign to us this is a potentially high probability to take a short trade. But all you want to do is you mark out the swing highs, you mark out the swing lows, you wait for price to come to those levels. When they come to that level, you observe how it reacts to that level, and then you can look for an entry. And for our second method in identifying these liquidity areas, we're going to look for higher time frame candle highs and lows. So for instance, over here, I'm on the weekly chart. You can see I'll mark out the weekly highs and I'll mark out the weekly low. And you can see here weekly highs and weekly lows. Basically, you just marking out the lowest low points and the highest high points. So you can see over here as price came to these weekly high points, we got a reaction at these levels, a rejection, then price dropped down, and we got a reaction at this lower level. Then we had continuation to the downside, continuation to the downside, and now look at this here. We're getting a failure to displace at this lower weekly level. Price closed with this failure to displace, and then we're getting continuation to the upside. If you've watched my daily bias video, you will understand exactly how to understand the bias and determine these reversals and continuations. So now I drop down to a daily time frame. I marked it on a weekly time frame, and you can see these are all my weekly high and low levels. If I mark them out neatly on the chart, you can see every time price gets to these levels, we often get a reaction off of them. Not every single time, but we have a high probability of getting a reaction off these levels. You can see when price got to these highs, we got a massive reaction, then price dropped all the way down. When we got to this low, we got a reaction. Price broke through these lows, so we didn't get a reaction, broke through these lows. We got a reaction at this point over here. You can see a nice reaction, and then price came down to these lows, and we got a reaction over here. So not all of them, but most of them we were able to get a reaction off of. The key principle here is just learning how to identify these high and low points on higher time frames, and then just observing how price reacts when it comes to these levels. Here is another example in the charts, and I'm on the weekly time frame again, and you can see we can mark out the lows. As price took out this weekly low, we got a failure to displace, and then we got a break in structure to the upside, which is showing us continuation. So you can see prices come all the way up here. If it's breaking these weekly highs, it can show continuation. If it's showing rejection at these weekly highs, it can show potential reversal. So you can see here, this is a weekly high, got taken out, and then we got a reversal at that high. Then we got a weekly low, and we got a reversal at that point. Now we can mark out this weekly high and this weekly low, and these can become potential areas we can look to see how price is going to react off of. We can also see this weekly low we got a reaction off of, and we've got this low that hasn't been mitigated yet, and we've got these highs over here. So what we'd want to see now is we'd want to wait for price to either come down to this low point and get a reaction, or we want to see price come to this high point and get a reaction. By marking out these higher time frame candle highs and lows, we're identifying resting liquidity, and then we're just waiting for price to come to these levels, and these become significant and relevant areas where we can look to take potential trades off of.